Bank of Canada held rates this morning at 5%. And while that sends a bit of a message of stability out to the marketplace, it's little reprieve for the millions of Canadians that are struggling to stay afloat with 20-year highs in interest rates, resulting in skyrocketing mortgage payments and businesses having to pull back in not only their spending, but also some of their employees. We're going to unpack today's announcement for you and offer advice, how to prepare for what's coming next, and share our current prediction as to when rate cuts may begin. So let's dive right in. So as mentioned off the top here, the Bank of Canada did hold rates at 5%. And this marks the fourth time they have held rates during this current rate hiking cycle. As a quick look into the press release, they mentioned that they held rates based on the weakening global economy, that oil prices are rising. There was uncertainty, of course, with the ongoing wars, and that inflation is remaining stubborn. A little bit closer to home here in Canada, these higher rates are still taking effect, is what they're saying. They're saying it's still working through the marketplace, and they're seeing some indicators now with lower consumer spending, with much weaker demand in housing. And they stated that indicators suggest that supply and demand in the economy are now approaching a balance. So again, more tone of stability out there. But as usual, they did leave the door open to further rate hikes, saying that, quote unquote, as they are concerned that progress towards price stability is slow and inflationary risks have increased, they are prepared to raise the policy rate further if needed. They kind of have to say that every single time in case, because of course, should they hike, then it won't become as such a surprise. Either way, the markets had correctly predicted that it was going to be a rate hold today. And there's now currently more indicators in the marketplace that rate hikes may very well have hit their peak. They may be done for this cycle. So when we look at 2023 as a whole, there's only been 2 rate hikes this whole year, only 0.5% total. And, while that does say a bit of stability, it's still no relief to all the Canadians that are still realizing the full effects of the 475 basis point hikes that we've experienced over the last 19 months. There are over 70,000 mortgages renewing every single month right now, and Canadians are looking to their lines of credit and credit cards just to stay afloat. The pressures of the high rates are very real, and the longer they remain high, the more cracks are going to appear in our system. So, to help unpack today's announcements and get a current understanding of the mortgage landscape, we have Mychal Ferreira with us. He is the #1 mortgage broker across Canada with the Bank of Montreal. Thank you so much for being here, Mychal. Let's dive into the first question. So with these 70,000 plus mortgages that are renewing every month, for homeowners with, let's say, a 5-year fixed term, their original mortgage was obtained at a time when the overnight rate was 1.75. Today, it's 5%. So what do these new payments look like for those renewing who, let's say, started with an $800,000 mortgage amount?
Yeah, so when we look back at 5 years ago, mortgage rates were like in the 3% range. So you would have taken an $800,000 mortgage on a 5-year fix, 3-ish%. You're looking at about a $33.64 monthly payment. Now with these maturities coming up, you're going to go into a 25-year amortization. Your mortgage residual balance is about $711,000. Your monthly payments jumping from $33.64 to $47.19 per month. That's a 40% increase to your mortgage payment since your first term, which is pretty crazy considering that there's about 331 billion mortgages in Canada maturing in 2024 and like another 300 billion in 2025. So I don't think we've necessarily seen a lot of the impact of these rates just yet.
So, Mychal, what about variable mortgages with, let's say, AMs now that are over 30 years? What happens at maturity here?
Yeah, so there's a few banks that have adjustable mortgages where your payment instantly moves up when the rate goes up, moves down when the rate goes down. But there's a whole whack of them that have basically it's like a variable fixed mortgage where rate goes up, the amortization extends, right? More payment goes towards interest, less towards principal. And what we've seen and what we keep hearing about out there is that, there's a whole bunch of mortgages that are north of 30 years. Now, at maturity, if you took a variable mortgage, say, during COVID, right? So you're 1.5 or even lower, and you have a fixed variable mortgage and your amortization is extended well past 30 years, then what ends up happening in maturity, if you haven't increased your payment or made lump sums, is you now have to catch up on the the principal payments that were missed over the term, and you got to deal with your increased rate. So you could see not only like a 40% increase in rate alone. In fact, it's probably like 50-60% if you were like in the 1 point somethings. But then now on top of that, you also have to catch up on the missed principal payments. You could be seeing a 60-70% increase in payments.
Wow. So that's kind of a nightmare scenario, I think, for some people here, where you buy a house with the intention of paying it down, only to realize that you actually have to pay more than maybe what you even paid for in total for the home, right? So difficult situation. I guess we'll see how how things continue to carry on here. But what kind of options do I have then? I mean, if can I extend the amortization period without requalifying, or should I be bouncing banks? What should I be doing here?
Yeah. So in short, you can't actually extend your amortization without refinancing or requalifying, right? If you are renewing your mortgage, basically you just go into your lender and you take a new term and you're good to go, right? So it's pretty straightforward. But if you need to extend your amortization, so say you're at 25 years now and you need to get back out to 30 so that your payment's smaller, you got to requalify. You got to, basically do a refinance. And the issue there is like, a lot of people, when they got these mortgages, were qualifying in the 4s and 5%, right? And now they're qualifying at 8%, 9%.
Ouch.
So, hopefully incomes have gone up, which they haven't. But, if your individual income has gone up, you might be lucky. But generally speaking, I've seen most people that have maturities actually can't even move their mortgage to another institution.
Wow. That's okay. One thing that, as an example, right? Like I rented out my basement suite to offset the interest-bearing portion that's risen on my mortgage, right? And I think, if you've got a property where that's an option, it's something you should be doing if you're staring down a, refinancing in the next 2 years here, because, 40% increase in payments is no joke,
Scary to think that a lot of people might not even qualify for their own home today when looked at it with those new rates. So, Mychal, as we talked about here, there's been 2 hikes this entire year. There's only been 1 hike in the last 10 months. And when you look at it through that lens, it almost feels a bit stable. Again, this is off the back of almost all-time record high rate of increases. But again, you look back 10 months, 1 hike, that sounds like it might be okay. What's your take? What's the Bank of Montreal stance right now, you think, on is the rate hike cycle done? Are we at the top?
Yeah, I mean, actually, when you look at most of the chief economists out there, but like with Bank of Montreal, our chief economist does believe that the rates are done. In fact, by the end of 2024, most banks are predicting that we'll hit our target rate of 2%, and we suspect that we'll start to see rates come down next year. Question is when, but I do believe that they've peaked. In fact, almost every bank analyst has predicted that it's peaked.
Okay. Yeah. Interesting. So based on all this information today, and we know the data changes daily, weekly, hourly, even, what's the current prediction? When can they expect the next rate cut based on the info we have today?
Yeah. So I think the earliest that we might see a cut is maybe summer 2024. That seems to be kind of the general consensus, all the way through 2025. But I think we'll see, assuming, there isn't some major economic disaster, but I think summer 2024, we'll see maybe a quarter point, maybe more, depending on how things kind of shake out.
Yeah, I think it's going to largely depend on how inflation plays out too throughout the year. And kind of like I mentioned, with some oil, seeing what happens to oil prices here. With that said, though, let's stay focused. For those that are, say, buying a house today, or at least in the very near future. Seeing as we're maybe at the top of this rate hike cycle, what would you start recommending in terms of products here? What should they be, looking at and considering based on the market?
Yeah, so if you're buying a home today, I would be recommending a short-term fixed rate. And the reason is because you don't really want any surprises in the short term. You kind of want to know what you're paying. And if the last 2 years have taught us anything, it's that's an important piece of buying a home. And going with a short-term fixed gives you some flexibility because most lenders allow you to get out of your mortgage like an early renewal within 4 to 6 months before maturity. So if you take a 2-year fixed, it's significantly higher than a 3-year, but you can get out of it in 18 months. So most people have been going with a 3-year fix because you can get out of it in 2.5 years. And it's the lowest for the shortest, right? And then when you're going into, some people are making the argument now for a variable as well. And the problem with the variable is that you're kind of taking a much higher rate. So for comparison, a 3-year fix is about 6.4. A 2-year fix is about 6.9. A variable is like prime at 7.2, right? Just ballpark figures, right? So you're taking a premium to take risk on the back that, if rates do come down, you can go ahead and turn your variable into a fixed with no penalty. So, there's an argument for variable, but I don't like the spread between the fixed and the variable rate, especially on a 3-year, because I don't know if taking that risk is worth it right now. There's just so much volatility. And every time I swear we've had this conversation that rates have peaked and then they go up, rates peaked and then they go up, right? So I'm like, at this point, I just, take the devil, and a 3-year fix just seems to be I would say 99% of what I'm doing is a 3-year fixed right now.
Got it. Good info. Okay, let's talk a little bit about mortgage arrears now. How many people are getting delinquent in their payments? And when we look to the data, it's actually pretty fascinating because Canada as a whole started off the year at a 0.16 delinquency rate, and it's actually fallen, meaning more people are out of delinquency. More people are covering their mortgages. Today, we sit at 0.15%. So from the Bank of Montreal standpoint, like what are you guys hearing on the ground? Are people super stressed? Are people about to be in arrears? Or what's sort of the landscape feel over there?
So honestly, a lot of what I've been doing in the last, several months has been reviewing customers, mortgages when they're renewing. What do their payments look like at maturity? I think most people pay attention to that kind of stuff, and they're looking ahead, and they're looking at what they need to do today to ensure that when their maturity comes up over the next year or 2 years, that they're ready, right? And, unless you have a homeowner, a HELOC, should I say, which is instantly changing constantly, a lot of people still have a lot of planning to do. So, what I'm basically seeing and why I don't believe mortgage arrears necessarily will take off is because no matter what, people pay their mortgage first. They always focus on that. They'll let their car go before they lose their home, right? And, I think right now everyone's aware that rates are high and they're doing what they need to do now. And that's why I think there's also that correlating effect with inflation. If people need to plan, like a lot of these mortgages, these rates have not been, have worked into these mortgages yet. As they start to come up, I think inflation will stay low and could potentially get, well under the target, potentially, assuming that these rates stay very high and there's all these people that need to make massive adjustments to their lifestyle, right? So I think we'll see it kind of stabilize.
Yeah, there's definitely a growing argument for another pivot coming sooner than expected, and I think that depends largely on the bond market. I think it also largely depends on conflicts throughout the Middle East and how that continues to impact our economy, right? So there's some black swan events that could exist here where we could get a harder pivot than maybe we expect. But again, that still has to play out. So let's talk presale, because there's a lot of people in the last 5 years or more who have been buying pre-sales has largely been their only option in many ways. And when they bought them, rates were at all-time lows. And now that's not the case going to complete. So are you seeing issues in that segment of the marketplace? And maybe if you wouldn't mind talking on how you mitigate them as well, just so people can be reminded of that.
I'm always extraordinarily surprised that a person will go and buy a pre-sale home, put down 15, 20%, and don't look at financing. I look at it, if you're going to buy a resale home, you don't just drop 20% and be like, oh, I'll figure out financing right before completion. So, right now it's something that I take a lot of time explaining to people. I get out and I tell literally everyone that I can about pre-sale financing. And the reason for that is what's happening now. We're starting to see a lot of these pre-sales that are coming up a little bit short, right? Or, in some cases, very short. And the thing is that if you bought a home, you paid $700,000 and it's worth, $650,000 today, and you've done no due diligence, you're now short $50,000 on top of your 20% deposit. Right.
Ouch.
And, I don't see it. I would say that maybe like 1 in 6 or 1 in 7, I see it coming up short, but I believe that number should increase as we start to see a lot of the peak COVID, pre-sales come up. I mean, all prices were, very, very high and things are flying off the shelf. And as those come up, it's natural to assume that the valuations will be soft. And one of the things that we can do is we can do full financing. We can, basically get you 100% approved. We can do an appraisal so that your valuation is safe. And then we can hold a rate for up to 3 years. So, and we don't look back. So basically, once we get to completion, your deal is done, right? There's no surprises. You have a rate, you have an appraisal, and you have the valuation secure. And for example, I've had to actually convince some people during COVID that bought pre-sales. I was like, just put in an approval. Just put in an approval. You'll have it for 3 years. And, clients would be like, no, I want a variable. I don't really want a fixed. And well, those same people I convinced are closing today, 5-year fixed, 30-year amortizations, 2.5%.
Wow.
Right? And there's no downside to do this. If you've bought in a pre-sale, do your financing, because at the very least, you have something to fall back on. If you don't need it, you don't need it. You don't need to use it.
And Mychal, just before we flip over to Dan here, I just want one follow-up question here. With those 1 in 6 and 1 in 7 that maybe are having significant issues, is the bank doing anything for them, or are they just, SOL and they've got to flip their unit kind of thing?
Well, it depends how out of whack it is, right? I think people will try to make it work, right? We find solutions. I work with them. We double check all the valuations to make sure, like, is this home, like, are the comparables there? So we always try to work with clients to make that, like, to find a solution. But sometimes people just pay too much, right? I mean, it happens to everybody. And if that's the case, then, you're going to see people just try to get their deposits back out of it. Right.
Yeah. I think just so many people don't know that they can get 3, 4, 5, 6 year rate holds in advance. And we'll continue to do our best of informing people, because as you mentioned, it is so important. And the last thing you want to do is get caught here and be 50, 100K negative and have to just come up with that cash almost overnight here. And speaking of sort of like stressors in that sort of segment of the marketplace, with the banks, like, they know that there's these $300, $400 billion in renewals coming in the upcoming years. And if rates stay high, like, are the banks are they preparing for offering people maybe some form of relief when they have to renew? And what I mean by that is, if you have to renew and you literally can't make the payment, can they offer something like a 40-year AM? Can they offer up a secondary mortgage to keep you in your house? Like, are those kind of conversations taking place?
So the one thing I can tell you is that the bank is never interested in trying, or banks in general, they don't want to take your home by any means, right? They don't want you to lose your home, and they're not in the business of taking over people's homes. They want you to stay in your home, and they will do everything that they can. Like, I work with my clients to crazy extents to try to make situations work. That being said, I've heard rumors of a 40-year amortization coming up at some point. Whether or not that happens, whether or not, government allows it is yet to be seen. We're seeing some lenders that already have that. But it's, I believe there was Equitable Bank that just released something that had a 40-year amortization, but they're talking about rates in the 9+% fees. So it's kind of like an extra product you can get, but as just like a 40-year amortization where all the banks have it. I mean, honestly, I it makes sense to me, even though financially it's not a great idea. I just think that it's kind of like the next step in our progression, because when you have high rates and very high prices, people need to be able to qualify. People need to be able to manage their payments. But I think it potentially could be coming, but there's nothing that has been, told to me or fully, that I can say that it is for sure coming.
Extend and defend.
Yeah. It's the name of the game right now.
But okay, well, let's have last question here on OSFI. Did they do any updates here? Are they going to tighten any further difficulty coming to qualifying?
Well, actually, this is one of the things that I've been thinking about all year, and I've been super stressed about it. And it's funny because not a lot of people were talking about it. So for those who don't know, OSFI is the regulatory body that brought in the stress test. They're the ones that basically control how we lend, how all lenders lend, and basically make it not more difficult, but protect our lending atmosphere, right? So there was all these talks about like debt service qualifications, basically like there was less you couldn't go over a certain threshold of your income. Whereas now there's a little bit more leeway. We can kind of work on things. We can mitigate more. But they're saying, 75% of all mortgage customers would not be able to exceed 450% of their income, right? So basically, when you do something like that, you take an already tough qualifying sector and you shrink it. And you make it much more difficult to qualify. They were talking about all sorts of things. There was even leverage lending. Like if you wanted to refinance a rental to buy another home, they wanted to put a stop to that. They did make some changes in the background, mostly to do with products like a home line or homeowner ready line, where you have a homeowner line of credit and a physical mortgage portion. But it looks like for now that they will not be doing any of that, which is honestly, it's the first positive news that I've heard in a little while. And it, we don't want to, at this point, it's like, how much more difficult could you make it for people to buy a home? I mean, you're already qualifying at 8-9%. Like, why are we going to add 2 more layers of complexity to that? So that's honestly the best news that I've heard. This is a moving target. The reality is if things get crazy again, they could jump in. But as of now, it just, it's kind of calmed itself down.
Well, look at that. Some good news from OSFI. Maybe we're at the top here of the rate hike cycle. Maybe there is light at the end of the tunnel. Mychal, thanks so much for being on here today. For those people who have mortgages and need to talk to a broker about what to do here, or anybody with a pre-sale who is not pre-qualified, how do they find you? How do they get a hold of you?
You can give me a call, send me an email, or find me on Instagram.
Perfect. We will include all of that contact information in the write-ups below. Thanks again for tuning in, and we will see you next week. Bye.